baby, put your strap on, get that seatbelt for this roller coaster ride unlike anything we've ever seen, because holy crap, this earnings period is going to be the true defining factor to the companies that can survive this higher interest rate recessionary market and the ones that truly can't. And to no surprise here, everybody was expecting it, but Tesla stock, selling cars is not the easiest thing to do in this kind of environment. We're going to talk about the slew of earnings we've seen so far, the stocks that have done well, the ones that haven't done well, and then we'll take a look at the broader markets, because so many of you obviously have that condition in mind, that responsibility of understanding cost averaging through a market like this will give you much better results than trying to pick and play what's going to do well. But again, I think most people are just completely, enamored, and they just don't foresee the end of this interest rate cycle. Basically, what's going to happen here is one of two things. Either interest rates need to start coming down, or asset prices need to start coming down. And in the meantime, while we wait for interest rates to come down, we're going to start seeing that effect on specific assets. So let's talk about these assets. And if that's a conversation you'd appreciate, as always, hit that like button, because Tesla.
Elon needs to get his ass off of Twitter and Diablo.
There is nobody that is bullish on this company anymore. There's nobody in their right mind. And the only thing that's going to keep this stock up is the diamond handlers. And I do not think they are going to last long enough to keep this thing above $200. In my humble opinion, I could be wrong. Don't get me wrong either, because I'm bullish on the company long term. I know this is going to be a temporary problem, but people just don't like temporary problems lasting 6 to 12 months. It affects them mentally. They don't have the fortitude to survive that kind of cycle. Hell, I have a hard time surviving that kind of cycle. But Tesla's running into the problem of EPS growth. No longer are we going to see 50% growth rates, at least for the next 6 to 12 months, out of this company. And when EPS starts going negative, the stock price usually reflects it. My God, look at their total revenues, only grew by 9% and have actually flatlined over the last 4 quarters. If this starts taking effect into the end of this year and into Q1, say goodbye to anybody that had an ounce of bullish nature in them. I'll still be here. I'll still be telling you we're going to come out on the other side of this, and Tesla is still the predominant auto company that will likely take over most of the entire space by market share in the future. People won't believe that. I still believe we're going to head in that direction, but you can't help but recognize car companies and just anybody that has to deal with these high valued sales in this kind of interest rate market don't do well, because people just can't afford to do it. That's why they're cutting price. That's why their margins are compressing, and that's why the stock is going to go down. Now, I am going to keep my eye on this. Anything under $200, I don't know where I'll start entering, but I want to get access to my TFSA. So probably come January, I will likely be dipping my toes into this company, because this is the opportunity of a lifetime. You need to understand the value propositions that are being foretold to you in these prices that have retraced by years. This is only going to happen probably once for the next decade. These kind of markets don't come around very often, folks, so don't get too skittish, because you just got to have fortitude. From the impatient to the patient does wealth ever prosperity be born. I don't know, I'm over quoting Warren Buffett, but look at Netflix. Netflix, again, absolutely exploded here, and I don't like Netflix. I've stated that you could like Netflix. I don't hate people that do like investing in this company. I just believe Google has a bigger moat for a long-term investor to prosper from, because Netflix has to bleed so much capital into entertainment, where Google is basically the leading streaming service today, from my understanding. But you take a look, for the first time ever, and I can only believe this is related to obviously cutting people from sharing passwords, so you can really only watch Netflix in one home. I think that's still taking effect in their earnings, but 7.8% here from Q3 of 2023. My God, and they have a forecast for 10% growth into Q4. So this is the biggest growth cycle they've basically experienced since Q3 of 2022. And yeah, investors are excited. So congrats to Netflix and people that have been holding through this, but I will never buy this company. It just doesn't appeal to me. But in the chip sector and every AI bull out there, that cycle is about to come to an end. I love the idea of trend investing. I made most of my money off trend investing. Trends tend to last for 6 to 12 months, and people are starting to wake up to the reality that, hey, maybe, this whole idea of AI, yeah, just like crypto and NFTs, has a real place in the market. It's probably not fully coming to fruition yet. Maybe we got too excited. Everybody talked about it, and that trend is finally probably going to come to an end, as we're seeing it with chip makers. I mean, their bookings plunged 42%. There's nothing really good coming out of these earnings cycles. Look at TSM. They actually bumped up nicely, which I don't understand these bump ups. It's the same thing with Tesla. They all bump up after earnings and then slump after the fact, because, I mean, the world's largest chip maker, they saw the biggest drop in profit in nearly, what is that? Like, we're talking about years, literally 5 years. Like, it's so abysmal, right? So take a look at their earnings, because, yeah, if you take a look at gross profit margin sitting at 296 billion, I believe, Taiwanese dollars, basically over this time last year was 370. on a little bit more revenue. Like they're seeing a decline in revenue, profits. You take a look at the month over month, and it's been negative basically every single month by like double digits, which this is just the new market cycle we're in here, folks. So who's surviving this? I mean, we've talked about companies that have experienced real pain already, and those are the ones that are pretty much necessity based, and they are starting to come out of this. Procter and Gamble, similar to Pepsi, I saw some synergies between these two earnings, and Procter and Gamble, I think, is one of these companies most people buy for pure stability during moments like this, and they are proving to be that defining factor, right? But what's the synergies that I've noticed is their organic sales growth went up, similar to Pepsi, but their organic volume is dropping off, which means pricing increases on these products are continuing to is continuing to be the driving factor for most of the sales growth, right? And you take a look at the earnings, their net sales here hit 21.8 billion, which was up 6% on a year-over-year basis. Gross profit, done a great job considering how bad inflation's affected a lot of these companies. Their gross profit was pretty healthy here at 16%, which was up pretty dramatically. So I got to give them some credit here, continuing to be a resilient. This is like the dividend-focused investor style of stock you'd want to buy, in my opinion. And just taking a look, we've talked about a lot of these earnings. I did a live stream, so congrats to everybody that joined the live stream and support me on Patreon, that we chat about this regularly in the chat group on WhatsApp. Feel free to click that link and join. But really my fixation has been on a lot of the banks, because US banks post before Canadian banks, and because of how large Canadian banks are, we do get a good reflection of, hey, if these mega cap US banks like JP Morgan, Bank of America are actually doing well, because let's be real, they crashed miserably already and they're starting to level off in their earnings. And if that kind of represents into the Canadian markets, we could start seeing a bottoming finally in perhaps some of these banks. We won't know really. This quarter will be the defining factor for that as we get to the final interest cycle of this interest peak cycle, because eventually, as soon as we can level off, that'll take full effect into all these companies. The stock prices will take their final hits through the next quarter or two, and then hopefully we can start sniffing out the interest rate cut cycle if inflation gets back to target price, which I think it will. And then by summer, it's probably spring and summer next year, I think we'll start seeing the bullish sentiment come back into play. So when does the market likely bottom here? Because nobody actually knows. But as I mentioned, if we're using catalysts to play this out, the bottom will be when interest rates have finally leveled off and have taken full effect in the real estate market. That'll take about a quarter or two to come in full effect, and we're in the midst of that quarter right now into next quarter. And then finally coming into next year, it'll just be the survival game of cutting cost and continuing to try and drive some value, but at least EPS and revenue should have finally taken the full effect, at which the sniff out of interest rate cuts will be the first bullish sign to start getting back into a recovery. Now, I don't think we revisit the October lows, because what's going to happen here is the October lows were purely visited by big tech crashing. And I think tech is starting to slow down, and we're going to start seeing, the growth lackluster there. But when it comes to the bottom half of the market that crashed miserably, I mean, every company outside of the Magnificent Seven got slaughtered. They're starting to finally find their bottoms, in my opinion, and they're starting to even grow, right? We're seeing a lot of these companies post great numbers. The banks especially, again, you're looking at things like AT&T and Procter Gamble. Those companies, so long as they remain resilient, that'll keep the lower half of the market up. So I highly doubt we go back to some crazy lows and we revisit the October 2022 period. I think we could see some sputtering, a little bit of up and down. I don't think we're revisiting all-time highs, but every dip the market is presenting to you right now is a buying opportunity. As mentioned, many of you know I sold a lot of my Canadian assets to pivot into US assets just to protect myself from dividend tax liabilities. But in this market, I will be taking full advantage as soon as I top up my TFSA. As it stands in this moment, I've got about 10K liquid for investments. I'm trying to grow that to get it up to maybe 15 or 20 by the end of the year, and I will be going just absolutely bonkers buying. And again, I'm not looking to buy everything all at once. I will probably lump sum invest that, but with the income I will be getting, it'll immediately be going into the market pretty much every other week. And I hope you'll subscribe to get those kind of updates, because I promise you, I just can't get over, what I see going on in the next 2 to 3 years and how bullish I feel into the future, and how now is the time to buy those diamonds in a rough that just have a hard time dealing with this high interest rate environment, because it's going to come to an end, folks. I promise you that. You just got to be patient. Be greedy when everybody is fearful, and of course, be diligent. Cost average, but if you can come up with extra capital, I would start taking stabs at stocks you like, especially if they're crashing. I mean, it's going to be that opportunity the next quarter or two. But stay cool, stay awesome, folks. I'll catch you in the next one.